Hi, this is Brian Resnick, President of Resnick Wealth Management. I'm bringing you an important update about the economy and the investment market, so hopefully you can better your portfolio. You know, every single week I continue to receive dozens of phone calls and emails from our radio listeners, really just kind of concerned about what they see out there, and also really a lack of direction from their current advisor or broker. And one of the things I want to stress is an investment strategy is more important than ever. And I would argue that 9 out of 10 investors, and I'm going to repeat that, 9 out of 10 investors do not have an investment strategy in writing, nor does your broker or advisor. Most advisors are merely brokers. Brokers sell investments. They can advise you on here, buy this or buy that, but they don't have an investment strategy. They don't manage your money. Don't kid yourself. Make sure you understand whether you're doing it yourself or you're using somebody. Is there an investment strategy? Is it in writing? Is it being followed religiously? If it is not, you are shooting from the hip. You're going to take excess risk, and you are going to ultimately, in my opinion, make a lot less money. If you've ever wondered why you hear, hold on, things will come back, or I'm always doing worse than the market's doing and I never recoup when the market comes back, A, you don't have an investment strategy and you're not following it. I hate to harp on that, but I think one of the biggest mistakes investors make is not truly understanding who they are using. Broker advisor or a real money manager, a registered investment advisor like a firm like us. I think too many investors today, again, use emotion. They're shooting from the hip. Emotions are going to get you into trouble. You're going to sell at the wrong time. You're going to buy at the wrong time. You're going to buy the wrong things at the wrong time. And I think today, more than ever, a lot of the things that I've talked about in the last 2 years have been spot on. Not only where the market is, where you need to invest, when you need to reduce risk. We've talked about our market trend indicators, our MTI, intermediate and long term. Both have triggered sells. That means you need to reduce risk. Caution is now advised. I fear we are headed for a double dip recession. I think we're 60% chance of that. We're watching our indicators. We'll make a change to the direction and what we will do depending on what's happening with not only our market trend indicators, but the relative strength on how we build our portfolios. I can tell you right now, we're sitting in a lot of cash, we have a lot of gold, and we have a lot of bonds. We have a substantial reduced allocation to equity-based investments, and I will repeat that you need to make changes when change is due. This is not a buy and hold environment. Buy and hold is not an investment strategy. I think too many investors get lulled into thinking that that person they're using is really watching their investments when all they are is a broker, and they're not responsible to watch or manage or reduce risk in your portfolio. Their job is to sell you something and keep you fully invested through thick and thin. Has buy and hold worked for your portfolio? I would argue for most of you investors it has not. That's why you do need to make changes to your portfolio when necessary, because it's appropriate. Investing is an ongoing process. We look at the housing market that I talked about 2 years ago. Yes, we've already hit a double dip recession in housing. Housing prices are dramatically down from where they were at the beginning of the year. I talked about that. I talked about bond prices. I've talked about interest rates. I've talked about the stock market and emerging markets. I think ultimately you have to really realize that what's going on in Europe right now is going to have a serious impact on the United States and all the economies in the world. Europe needs to get their house in order, and unfortunately they keep kicking the can down the road like the U.S. does. Now, can the U.S. come back and be a great investment place? Once again, I believe it can, but unfortunately our government is doing exactly all the wrong things, which is they're being political instead of doing what's exactly right for the country in order to grow this economy. And the way you grow the economy is private sector jobs. It'll be interesting to see what Obama has to say when he has his talk this week. My guess is going to be, if he says something halfway decent, you might see a little rise in the market and then another fall off. My guess is he's not going to have any real good rabbits to pull out of the hat, and a lot of the money that's been spent in the last 2.5 years after the credit debacle, a lot of it has been really wasted money. The government's never been a good allocator of capital, and when they create jobs on the government side, to me that is not a good place to be. You need private sector jobs, small, mid-sized, large companies growing. And I would argue that because of supply and demand, meaning consumers are generally tapped out in the U.S. and they're not spending, and high unemployment at around 9% plus, I believe that natural supply and demand is going to take a very, very long time from this point. I think we have another 3 to 5 years minimum to really get our house in order until we can really see this economy start to grow again. What does that mean? Relative strength investing. That's what we do every single day in our portfolios. We change things up when things need to be changed. I've talked about relative strength investing before. I would say call our office, sit down with my firm, find out why we're different from your Wall Street firm or your investment sales guy or your insurance agent. We're a different firm. We actually manage money. We have a strategy. We'll talk about how our strategies worked in the past, why we believe it will work in the future, and why making changes today are more important than ever. The economy is weak. I think we are at 60% chance, as I made a comment earlier, of a double-dip recession. I hope we can avoid that. A lot of that's going to be played out based upon what these governments, not only in Europe, but also in the United States, do to get their fiscal house in order to really improve unemployment, which will get people back to work, and that will help increase the supply and demand factor. If you don't grow the economy, you can't grow GDP, and that means you're stuck either neutral or you're going down. And I fear that we have a bigger risk on the downside of another 20% if we don't get things in order. I would advise caution again. We've already built that into our client portfolios. We've already made changes. What have you done with your portfolio? I would argue to be cautious at this point unless there are some real disciplined approaches to growing this economy. We'll find out what happens this week. But until Sunday's show, make sure you have yourself an extremely profitable day. And as always, call our office for a consultation. It doesn't hurt to talk. Find out the differences on how our portfolio strategy works and how it can benefit your retirement. Until Sunday's show again, make sure you have yourself an extremely profitable week.